Welcome everyone. Welcome to this Market Thursday, December the 16th, 8 o'clock here in London. This is the last webinar of the year, of the season. I'm going to try to be doing the same next year, maybe different versions. Need to do some improvement or make it a bit different. Thank you for joining today. For those of you who are watching on YouTube, thank you for joining as well and watching. So this webinar is not investment advice. This is for information purely. I do not take responsibility for losses incurred by the viewers. So please do your own research before doing anything. So today, what are we going to do? So let me if I can quickly going through my background. Started in 2000 in Paris, cash equity trader, worked there for 4 years. Then I arrived in London, worked for a hedge fund called Griffin Capital Management. I worked there for 4 years on the long only product, long short product. We were managing as a company almost 3 billion. The Western part was running between $500 million to $1 billion. And in 2008, I joined 2009. I joined Infinity Capital Market as a prop trader, working on an absolute mandate with no asset region constraints or long short absolute mandate, where you want and only be making money. From 2014, I started to do mentoring for another education company that I left in 2017. At the start of 2018, I stopped trading. I was pretty tired. And I concentrate myself on doing not much and doing a bit of mentoring as well that I've done since then. I launched in 2018 my own company, started the 4x4 video series in 2019, and I've been restarting active trading since the start of this year, where I rejoined Infinity Capital Market. And in the meantime, I'm still doing mentoring sessions, mentoring programs, and the things that you probably know now. So today, what we're going to do, as always, a bit of situation across asset classes, looking at the 4 asset classes and the recent performances. It's not going to be a too long webinar because this is the end of the year and Christmas is coming soon. So we're going to be talking obviously about what happened today and yesterday with the Fed meeting yesterday, the announcement, a bit of ECB, a bit of Bank of England. Then very quickly, a bit of more active trading and what's going to happen tomorrow with the Quadruple Witching and the index rebalancing. So last couple of days, as I just said, we had many central banks on the tape. We had the Fed yesterday with the Fed, the chairman, Powell, yesterday on tape, on TV from 7:30 to 8:30. It actually it was pretty good. I think it was better than usual. Louis looked prepared. The previous sessions, that it was not that great. Today, we had the Bank of England that announced rate hike. We had the ECB. The ECB is always harder to read. So on one hand, you get the Fed, who said that inflation is coming. Same for the Bank of England, that they're going to be hiking in the future. That's true for the Fed, that announced yesterday that they will be hiking rates in 2022 3 times by 25 bips. And in the meantime, ECB said, you know, we're not going to do much. So they're going to be playing a bit of with QE, tapering, no tapering. I didn't listen to the conference call of my fellow Lagarde. I was just too bored to listen to it. But yesterday was a good one. So what's going to happen after the expiry tomorrow we get the quadruple witching or the triple witching with a lot of expiry. So a lot of books will be, your position will be closed. If you think about the last biggest expiry, which was on the 3rd Friday of September, since then a lot happened. The market moved a lot and moved a lot across asset classes. So there will be a lot of closing of positions of gamma and delta and whatever you name them. And normally After that, the market is on average quieter. Having said that, the last time I told you that the market will be quiet was for Thanksgiving on the Friday, and I told you, normally on the Friday you don't do much. Thanksgiving is very quiet. There's nothing happening, and the market went down 3 to 5%. So don't take my word as granted. And if I'm saying that it's going to be quiet from next week, probably many things are going to be happening. This year has been pretty special. There has been a lot of dispersion, but normally what you have until the end of the year is people are reducing exposure, gross exposure, net exposure. You should have, and you could have, a bit of window dressing, meaning people will get rid of some positions that they think that they don't want people think that they were long or short. And on the contrary, they could be buying some of the winners just to pretend that they were long those names. There has been as well a bit of tax of people selling some losers, so which is normally something that happens between the 15th of November and the 15th of December, where to pay less taxes, you're going to be selling some of the losers. So those losers are underperforming on average during that period, and then there is a reversion to the mean. So that's something that I try to discuss with people on the community, because I think this is always interesting to understand the cyclicality, or should I say the seasonality of the different strategies that could be applied. So let's start as usual with the asset classes performance year to date. Again, that is as of yesterday. Today the market is a bit shaky, to say the least. So the S&P is giving back 1%. The Nasdaq is giving up 2% from yesterday. The lot of the big tech names are getting killed today, from Apple to the NVIDIA to the UPST to whatever. So tech is underperforming today, but so far for this year, you can see that more or less the market is up between 15 and 25% for developed markets. So it has been a very strong year for developed market, a bit less for emerging markets, which have been suffering from the COVID cases, from as well risk on, risk off, and investors going more for developed economies, as developed economies have been outperforming overall the emerging market economies. If for the dollar has been doing pretty well this year, as we can see here. Again, start of the year, which was in January, everyone was telling us the dollar is going to be very weak this year. Dollar has been pretty strong. So that is something that we try to discuss the start of January with the outlook for 2022. Bitcoin up 70%. I'm not the crypto guy, but I'm just looking at crypto in terms of these days of risk on, risk off, and if it is making any correlation still alive. Crypto through the Bitcoin has been pretty weakish, to say the least, no matter what kind of market we had. So it's trading between 47,000 and 50,000, but it's really so that the risk appetite that we had from the meme stocks, the crypto, is gone for the time being. And when I say gone, is pretty much gone, because if we look at most of those meme stocks, of those growth stocks with no revenues, they have been down between 25 and 75% from their year to date. So as we discussed a couple of weeks ago, there has been a poor market breadth, and there has been a lot of the dispersion in the market, meaning despite the S&P, the Nasdaq being 2 to 3% from their all-time highs, the winners have been, we don't have that many winners, and in terms of the constituents of those indexes, you have many constituents that are down quite a lot from the recent highs, or that trading below the 50 days or even the 200 moving averages. So it has been, at least for this quarter, the Q4, very weird market, a lot of dispersion, which in terms of trading was pretty interesting. So I hope that we're going to have that kind of volatility going into next year. WTI up 46%, and the gold down 6%, and gold not doing much. Again, a lot of noise. So please go away from this as long as nothing is happening. Months to date, instead of doing 5 days, I just wanted to look at the picture of the months to date. And again, it's as of yesterday. So in other words, the market is literally moving quite a lot. So we have the implied volatility with the S&P VIX at between 20 and 25%, but actually the realized volatility is high as well. That is true for the S&P, that is very true for the NASDAQ. So every day you get big change. So if we look at this table, actually the S&P on the months is now up 2%, the NASDAQ is down 2%. So that changes pretty quickly, telling you that in a market like this one, you need to be active with your positions. What happens is normally, if you think about 6-9 months ago, the stocks were moving, but they were not, let's say, having that kind of volatility from one day to another. So market used to be one-way traffic, going up and up and up and up. Everything was going up with a lot of passive investment, a lot of V-shaped recovery. But since, let's say, June and a bit afterwards, that we had dispersion in the market. So the top was obviously the meme with the February, March, but really for the last 6 months, there is a lot of dispersion. So I think what works well in this market is to be trading part of your position. So if you take, let's say, a $10,000 position, you should be able to be trading half of it, because the moves are going to be quite big. Next slide, year-to-date sector performances. So that's something that we discussed over and over. The change is not that big, but what is interesting is the months-to-date sector performances, with utilities and consumer staples really outperforming the market. So utilities, XLU, consumer staples, XLP, very strong this month. So there has been a bit of defensive, obviously. People going for more defensive stories, but that tells you really there has been, I mean, rotation is not necessarily the name, but rotation, dispersion has been absolutely huge over the last 2 months. I mean, we have seen with hedge funds killed on some big names, but to see the utilities or the consumer staples being up 7-8% in less than 2 weeks is a significant move. So I strongly advise you, as I'm trying to teach in the 4x4, and as well when we do the mentoring sessions, is always to understand, you know, which assets, which sectors, which industries are been moving, and you can do that on the 1 week, 2 weeks, months, 3 months, 6 months, because that tells you a lot about, you know, the rhythm, the music of the market. And if you don't listen to what the market is telling you, then you're going for trouble. You're looking for trouble. This slide, very quickly looking at the bonds. So where the US 10 years is hovering around this 140, 150%. There has been a bit of a move in the European bonds, a bit more volatility. The VIX, again, so that was as of yesterday, 19%, but today is higher, obviously, 20, 21, which we had a pretty significant rise in the volatility over the last 3 to 6 months. As I said before, both implied volatility and realized volatility. So the market conditions have been totally different from one half to another. I guess what happens very often is people make good money in a certain market, but they take too much time to adjust to a new market, and they're gonna say, oh, it's not necessarily changing, the market should be the same. From my experience, I think you need to be, in those cases, be listening to your P&L, meaning that if your P&L has been trending nicely and suddenly there is a change, this is a warning. And I know, on the other hand, what people are going to tell me, that you should not be prisoner of your P&L and looking only at your P&L, but it tells you a lot in reality. So sometimes you can do it with your portfolio. I can tell you exactly the same when I'm looking at the P&L of the overall trading room. When I get a chance to look at it, sometimes I can see it on a daily basis. And when there is a big change, I know that the underlying market is really changing. And that is why you need as well to have monthly stop loss or monthly cool down. So if you're down more than 3-5%, you reduce exposure by, let's say, 50%. And if you're down, 5% plus 7-10% on the month, you just stop everything, because really the market turns. I experienced that in a very bad way in 2006. I was still young and full of energy, but P&L does the talking. It's not only the market. So listen to both. What about we move to the technical analysis? So let's look at the names that we are normally looking. So the VIX. So this is a weekly VIX for the people who are new or are joining on YouTube later. The VIX is the implied volatility at 30 days for the S&P. That's a good, an easy proxy to understand the overall the volatility. This is not necessarily the best one, but let's say it's good enough. So we get here the VIX at between 21 and 22%, 19%. As I said before, we get the expiry tomorrow. So the options are expiring on the S&P. They are not expiring on the VIX. So the VIX is expiring next Wednesday. So there is a bit of divergence or time decay between the two. There is a lot of positioning. So if we look at the S&P, can we do, yes, the S&P futures, there is, as you see, a lot of volatility between this 4,600 and this 4,720, 4,750. Interestingly, sorry for my English, this is my French background, so sometimes I'm struggling. But there is a big position that was open. I think it was a couple of days or 3 days ago. You can go and look on the CBOE.com website. There is a big call spread, 4650, 4750. I think it's 20,000 or 25,000 contracts that are expiring the next Friday, not this Friday, but the Friday after. And that means, there is a good chance that the market will be pinned between this 4650 and this 4750. And today is pretty interesting, because when we start to move away from the 4750, 4700, we are selling the future and we go into the 4650, and then it stops at 4650. So something that I discussed over and over during the webinars, when we are getting closer to the expiries, try to look at where are the open interest on the big contracts, especially for the S&P, so the SPX and the SPY. If you have single name positions, always look at similarly, for tomorrow, for instance, where are the big open interest? Okay, where is the gamma, where is the delta? Because you will see that very often naturally the underlying will move towards those strikes. And if you put a position, let's say now, 3 months down the line, looking at the strikes, I find it always interesting to spot where are the open interest, because that will help you in identifying what are the very important level going into the next 3 months. So the S&P, if I'm supposed to do a bit of technical analysis, you see the 47.20. I want to go back into the long-term picture. Let me speak. What kind of chart do I have here? Yeah, I mean logarithmic. So if we do regular and if we do the S&P, I like it better. So the trend that we had from September 2020, we got the top here. We are always, you know, going through this trend. If you add a bit longer, you see here that the 47.20, 47.30 is not a big level, but it is a level, clearly. If you have a Christmas rally after the expiry going into the next couple of weeks, you could expect the market going into the 48.50, 4900. Okay, so that will be the top of this range. Again, we'll see what's going to be the risk appetite going after the expiry, but that will be the level. Again, keeping in mind 46.50, 47.50 big levels going for the next few days. Which one? XIC, Nasdaq Composite. So Nasdaq Composite today, big down day. So we are giving back almost the move that we did as of yesterday, that we did yesterday. There is no similar, there is no real traction, there is no momentum on the Nasdaq. And inside the Nasdaq, there is really big movers. So that makes let's say the momentum much harder to identify. I think people have been really struggling. Very often what happens for these last expiries, people will be closing their positions no matter what. Okay, so if something is down 7% and they need to close it, they're going to sell it, and they're going to sell it at -10, -12. So it's like, you know, you want to end the year and you want to start with a new book. So that is not surprising that those moves are exacerbated. That is even more true after this volatile year. So despite, again, the market doing like this and being at all-time high, implied volatility and realized volatility is pretty much high. Russell, this one is an interesting chart because we've been talking about it since March, consolidating between those two. There was here what we call a bull trap, where a bull trap by the name is you buying thinking it's going to go higher, and then it's not. I should be putting the volume with the you can do that with the ETF, but it is now trading at the bottom of the range. That is an interesting chart and price action to follow. A bit of Europe for the European followers. Chart is very much the same as the Nasdaq, like so you don't have much traction. The move has not been obviously as strong, but actually for the year, the chart has been pretty bullish. Now going into the sectors, XLU. So we just discussed looking at the price action over the last months to date. So let's give you a weekly chart. So that has been the trend. So we had a trend that started in 2009, trending, now making new highs. So that is quite interesting that utilities are making new highs. I think it's probably, it's not that I think it is defensive, but is as well the idea that yields rates are not going to go crazy high. So if we look at the next slides that we're going to be doing, we know now that the Fed is going to be doing 325 bips normally next year, but we are not expecting the Fed to be extremely aggressive going forward or after 2022. And that means as well the US 10 years, so US 10 years up, is it this one? Yeah, US 10 years is trading around, 150, 160. So on one hand, you had a lot of talks about inflation, inflation is there. There is clearly inflation. CPI, PCE is above 4 to 5%. But the Fed is not panicking. I think the inflation expectations are now coming down a bit. And that tells you that you probably the yields, a lot of talk, but if you do, instead of doing a weekly, you do a daily chart, you can see that since March, we have been trading between 120 and 170. So the average of 140, which is helpful for utilities, because if you think what utilities are doing is they have huge balance sheet. And when you have huge balance sheet, you don't want the cost of borrowing to go higher. So I think that has been helping the utilities months to date. This better visibility on the yields going forward. If you look at the XLP, so that's for the consumer staples. I mean, this chart, this breakout, so for the breakout fans, so that has been happening here, 73, bang. Okay, so it goes like it goes by 5%, 5% in 5 sessions. So a breakout, literally you can do it on stocks, you can do it on industries, on indexes. You can see how it works. Actually, what is interesting is the breakout was not really done in big volume. So now it's gone. And if you look at some constituents of the XLP, so one of the ways of IG generation is to go from the sector into the several constituents of them. And that is the story of Procter and Gamble, sorry. So Procter and Gamble, which went from 150 to 160, 161. So 6-7% in less than 10 days. So very, very strong for these names. That's the true as well, I think, for Pepsi, if I'm correct, which is another big chunk of the XLP. So try to understand what is moving, what is making the market moving. Other names on the other end of the spectrum, which is Adobe. So Adobe, they came with their earnings today. I think the earnings were in line, but what is more concerning is the expectation for next year, where the sales have been 2 to 3% below the consensus. So this sector, this industry has been on the tier, but actually we started to see some hiccup from similar to many of those names from the start of November. So today, big gap on the way down, big volume. It is close to this 550 support. So some stock to monitor. You can as well monitor some of the rec through for other names. I'm thinking about names in Europe, names like Dassault System, SAP, where SAP was doing fine today with Accenture, but Dassault System and some other names. So that would be on the single name. I'm looking as well at Apple, like all of us. So today, a very bad day, but that needs to be put into the context of the move that we have since the mid-November, where the stock went from 150 to 180, and every single day we had the opening of new strikes for options. So today the stock is giving a bit back. I think there is a lot of open positions. Now the market, the S&P, you see 4680. Again, the 4650 has been playing its role so far between 4650 and 4750. Remember that the S&P options are expiring on the open Friday tomorrow, and for the SPY at the close. Okay, so make sure that thought on the dollar for that, David. I've been discussing the euro dollar, David, over and over. So I think it's at an important level here. I want to believe that not necessarily get a view, and I want to be a Euro pro. I think that the move has been down. Having said that, the issue now that you might raise is the carry trade. I mean, even if there's no carry, I mean, it's a small carry, but if the Fed is going to be hiking rates next year and the 10 years is at 1.5, and on the other hand, Lagarde and its friends is saying, you know, we're not going to be doing much, that should help the dollar. But, you know, I believe the price action here. So I will say that as long as we stay above this 110, 111, I will be Euro positive. I don't have any position here. As I said before, you know, going long the dollar and closing around this 112.50, 113. So I'm not sure, David, you were asking particularly on, but euro dollar or another one, but the dollar, I'm going to be doing a bit more work for this webinar going into next year, because I think obviously there is a lot of questions around the dollar, and I start of every single year, this is important to get a view. Philadelphia Semiconductor. So I think here there is a trade. I'm not going to tell you what is the trade, because I've been wrong always. So if I've been wrong always, you kind of understand what is the trade I want to be pushing for. So there is consolidation. My view now is there is a lot of production supply coming on stream in the next couple of years. So I've been starting to discuss that with the community. I think probably one trade is to be looking at long dated options, because you get many of those stocks that are trading on 10 times revenues. So I don't know if that's true the SOX, if that's true NVDA, if that's true whatever names, but I think there is a good trade. I haven't found yet the way to structure the trade, but I'm always looking at the SOX, because this is the really a good leading indicator so far, which has been really a leader of this market. Okay. If further webinars, so David, this is a good idea. If you have suggestion, or if you want to be discussing some stocks, some ETF, whatever, just send me an email before the session. That way I can try to cover it during the session. My question on my opinion on DeFi, decentralized finance. I'm pretty bad. Maybe I'm too old. But the blockchain technology, I like it. I think this is a great technology and it makes complete sense. And if you think about payment, if you think about many things that we are doing in our day-to-day life, DeFi or, you know, blockchain will be part of it, and will be even, and will get bigger and bigger. If you ask me about the crypto, I'm not very good. Mark asking about the Bank of England today. Lots of people offside. I mean, that's quite funny, because on Twitter I'm following those so-called UK specialists. There is this young guy doing FX, and he was saying, you know, no, they're not going to do anything. And today he was like, oh, I was wrong. It's funny because, you know, the Bank of England said 6 weeks ago, we're going to do something. Then they say, oh, no, we're not going to do anything. And then they did something. What happened over the last couple of months, and you don't need to be a trader or portfolio manager, you just need to be someone to realize that there has been a big push from politicians, from Biden, from politicians in Europe, in the UK, for the central bankers to fight inflation. So inflation has been around quite a lot for the last 6 to 9 months. Okay, so if you start to look at the CPI, the PCE, And I'm not only talking at US, I'm looking about the UK. It has been around since big time or over their mandate since, let's say, March, April. Okay, so it has been around. The thing is, the central bankers will tell you, oh, I'm independent, I can do whatever the fuck I want to do. Okay, but the reality that it's not very true. Okay, if you listen to Powell yesterday, that was a bit weird because he said, 10 days before meeting Biden, I said, we need to do something on inflation. So he was kind of saying, this is not because I've seen met Biden and I've been reappointed as the Fed chairman that I'm doing now something, or I do care now about inflation. And that's the same in the UK. On the one hand, they say in a very weird way, the economy is going to be probably going to slow down. The COVID variant, the Omicron, whatever this name, is going to be bad. And on the other hand, they say, oh, inflation. So I think they have to do something because otherwise, people will burn the street. That's it. And the Turkish lira, yeah, my view is, I thought that, I think it was at 1350. I didn't take any position, okay? 1350, they will act in good manner. I don't know if good manner is the right word. And it carries on. So every single day I look at it and say, okay, I want to do something like, don't go. It's like, buying, that would be exactly the same as buying a shit stock with a bad balance sheet and you're trying to find the bottom. That the underlying is a bad story, but you're just trying to play the reversion to the mean. So I don't know. There's going to be a trade at one stage. For the time being, fighting, they cut the overnight to 14%, which was expected, but still, it goes against, this 20% inflation. There was a lot of announcements saying we're going to do something pretty soon. Look, the currency is down 100% in the last. So it went from 8 to 16 over the last 3 months. They said that they're going to increase the minimum wage by 50%. It's hard. Look, I'm not an FX. I'm not an FX trader. First thing, okay. So I do trade FX from time to time, but this is really not my core business. And when I look at something like this, again, this is as trading a bad fundamental story. So that means it's going to be pure aggressive trading where that the underlying is not good. But if you've been obviously in it since the 9, that's a one-way traffic and it works well. And the S&P, which carries on. Okay, let's go back into the slides. If you have question, you can send question in the chat. I think it works well today. Quickly, some charts on the US retail sales. So when was it? Yesterday or the day before? I can't remember. I think it was a couple of days ago. That was anyway. Retail sales. So retail sales plus. So if we look at the core auto, ex-auto and gas plus 0.2%. Months on month, so it came lower. So let me up. So that's the pace here. It came lower than the expectation. So on one hand, you can argue that year on year, all these numbers are looking very good. Okay, so this is not the end of the world. On the other hand, and there is a question mark of if it's only a one-off slowdown. So as you remember or not, and if you don't, maybe you can look at the webinar from a month ago. But the king customer in the US. So the US economy, 70–80% of the GDP is coming from the US consumer. Was very strong, doing very strong until more or less the Black Friday, Cyber Monday. So we had an okay Black Friday, Cyber Monday, but just, up 1–2%. So nothing spectacular. So here there is a question mark if the US consumer was buying a ton just before, or if the inflation is a bit killing the consumption, and as well, COVID, a bit of questions. So if retail have been very helpful, obviously, for earnings to go up. We need to check from next month, from January, how these US retail sales are going to be doing. So it's not a red flag, it's just an orange flag for the time being. But again, if you look as well at some of the discounters or some of the retailers, we are talking Macy's, which was on the tier and came back, but the price action has not been really, really strong. 46.85 on the S&P. Come on, baby. NFIB, small business. So NFIB, which stands for the National Federation of Independent Business. So this is all the companies that have small companies that have less than 50 employees. And that's the picture that we had since 2015. You can see the trend of this is for the outlook for general business conditions. So small businesses have, the perception has not been great, which is completely understandable for some reasons. They are struggling with finding the right people, the labor force. So that's the first thing. They are struggling with inflation. So if you think about the big companies, the S&P 500 companies, it's much easier for them to pass on labor costs, to pass on inflation. So that means they can, and they have been able to have higher higher margins, operating margins. For small companies, that is sometimes much harder. So again, this is another thing to follow, to check in the future. I got a question. It's another topic from David to have a view on EDF. Yes, I have a view on EDF. I traded it today. I missed the 1090 sell euro because the ball from my back office took ages, so I was pretty pissed. So the view is still the following. It's the problem with EDF is not right now what they are producing, which now they are making a ton of money. But it's what you do in the future with nuclear waste, okay? And if you think that all those nuclear plants got a 20, 30, 40 years life expectancy, at the end of it, you need to do something out of it. So I fully understand, when Twitter is going ballistic and has been ballistic over the last 12 months over the nuclear energy. And that's something that actually, if you look at my Outlook 2020, the start of January 2020, when, URA was at 10, 11, I said, this is a strong long. As a French, where 70% of the production is done with nuclear, that it's a cheap way of producing electricity. But there is one constraint, which is first, you need to find some product to deal with. Okay, so that's for the uranium, and at the end of the day, you need to deal with the waste, and that means down the line, the technology is pretty secure now. Okay, so I'm not a specialist, but the technology is pretty good. But still, what you do, so what the French used to do is they were sending all the nuclear waste to Australia or one of those countries, and they say, okay, I don't care. Now we need to care. So EDF, my view on David, and then I'm going to stop and move on. My view on utilities, and actually it has been pretty strong over the last months, is utilities. Everyone is paying a utility bill. Okay, so it's very easy for any politician in the world to regulate the prices of utilities. So you can be in a so-called socialist country like France or a non-socialist country like the US. You will see the politicians doing exactly the same with utilities. They will intervene, and they will always intervene because obviously that affects everyone. So in other words, for all the utilities, it's very hard to be price maker. So they have a limitation in their ability of passing on the cost or passing on something to the customers. And you can see that these days in Italy. It's true in Spain, that is true in France, that's going to be true in the UK, and that's the same in the US. So the view on these things, there's a lot of politics involved. and a lot of regulation. Okay, David, sorry for the other one. NASDAQ volatility that I mentioned. So here we are looking at the NASDAQ volatility in white, the volatility 5 days, 10 days, or 30 days. I took a bit of everything, but what I wanted you to get, it's not only the implied volatility, which is going higher, it's the realized volatility as well. So if we do, can I do something with my pen? No, I want to go back here. Pen. You see here, it's going higher. So the trend has been really, really higher, and it has been really picking up since November. So we had a kind of a through in at the start of November, but since then, really higher realized volatility, a lot of dispersion. Check something that I explained before. I explained as well in the 4x4 video series, which is tracking the realized volatility versus the implied volatility. By definition, normally implied volatility is higher than the realized volatility. Why? Because you pay more to hedge yourself. So you're thinking more that this is going to be the end of the world. So there's always let's say a 5% difference between realized and implied volatility. And sometimes it goes the other way around. And these days, the realized volatility is pretty high. Fed expectations quickly. So we had the Fed yesterday. As I said before, Powell was talking. It was pretty good. Here we are looking at the euro-dollar curve, euro-dollar contracts, and I put the euro-dollar at the start of November, on the 4th of November, and as of today. And we are looking from December 2021 to March 2024. So the first thing that you can see so that if you look at the bottom, if we look at December 2021 versus December 2022, you get roughly 85 bips. Okay, so 85 bips, meaning we know that there's going to be over the last 3 months 3 times 25 bips roughly. Okay, if you look forward, the story is not for many increases going forward, as we're going to be looking into the next slide. What is interesting going into the next slide is the expectation, or the curve has not been moving that much over the last month. So if we go through the webinars that we've done a month ago, we knew already that the market was pricing 2 or 3 rate hikes a month ago. Okay, so now you're going to read the newspaper and they're going to tell you, oh, the Fed is going to be hiking rate, or what a surprise, you know, inflation. We knew it over the last couple of months. That was already priced, so there is no surprise. So it's kind, you know, the Fed was saying, no, we're not going to do, no, we're not going to do. And then they, oh, by the way, we're going to do this 2 to 3 times hike. And here there is a big question mark, because obviously the Fed has been saying, no. Bank of England has been messing around with the market expectation as well. And the ECB is saying, you know, we're not going to do anything. So it's always a test of how long, if the market moves already the expectations, how long the central banks could wait for not doing anything. I think this chart is interesting because this is the euro-dollar curve again, where in orange you get as of yesterday. In green, this is as of last week. And in blue, this is as of a month ago. So if we look after June 2024, from here, everything went up. In other words, that part we are expecting, market participants are expecting the Fed to be same aggressively over the last months for the next 2 years. Okay, so we will go from 99.80 to 80.25. Okay, so we're going to be up from 0% to 1.5%. Okay, and then instead of doing more and going from 1.5% to, let's say, 220 or 250, now the market is saying we're going to be staying at 150. So Fed is going to be pretty aggressive. I mean, aggressive, expected to be 3 times this next year and another 3 times going into 24. So that means over the next 24 months, the market is expecting 6 rate hikes, 1.5% hike, and then everyone is off. Whereas before we were expecting more to come in 2024 and onwards, which means probably first that inflation is going to be strong for the next 6 to 9 months, then should be coming down. And as well that the growth expectations have been lowered, okay, have been coming down. So that's something that I've been raising a couple of months ago, which is, I think the 2024 expectations have been lowered quite a lot, meaning that the GDP growth are not going to be very strong. But I think this chart is probably the most important chart of today, and that's a good summary. If you look at, so here this is from Bank of America, where here you'll be looking of what we called the terminal rate. Okay, so where the Fed is going to be on hold or not going to be doing much. So as we've seen before, the euro-dollar curve is pricing 6 moves from 98.80 to 99.80 from 98.50. So a quick 6 and down high cycle over the next 2 years. Then this is it. Okay. So this is for expectations, for the market expectations. Really important. You don't need to be a genius to understand those things. It helps. And I think it helps massively to get away from the noise on Twitter, on CNBC, on the FT, on The Economist, and everything. You know what the market is pricing. Fed versus the ECB, I just put like 4 headlines from the ECB. So Lagarde, very unlikely that the ECB will raise rates in 2022, that the ECB to conduct up at 20 billion per month from October. So there was a lot of app, PEP, and all those things, which is, you know, QE, not QE. I'm going to be adding 20 billion, less 20 billion. As I said, I didn't listen to the call, to the conference. I was just reading the tape. I think she's always very confusing. She's not very good at doing it. Maybe I mean, it's easy for me to say that. I think it's the jobs that they have is super hard. So I'm not pretending that by no means that I will do better. But I think as a small market participant, I will say that it's the message that the ECB is giving is not that great. So there is a lot of bad explaining, which, to come back to your question before, David, on the dollar and for the euro dollar, even if the chart tells me that the euro could be bouncing, the way that the ECB has been communicating recently versus the better way the Fed has been doing is for me a bit of a concern. Mark is asking about China, thoughts about China. So China, we've seen the leading indicators, we've seen the tape, which is, you know, from the start of this year, China was slowing. So if you look at, if you listen to the webinar that I've done in January, when everyone was saying, you know, go long emerging market, I've been saying 2 things. I've been saying the first thing, I'm not that bullish emerging market because, you know, it's if you look at EM, it's 60% China. And I think the problem that you have with China for assets, okay, is you need to put a discount to those assets. So I remember having starting a mentoring program in I think it was January or February. And one of my mentees was long Alibaba, was long, I don't know, it was Tencent or whatever. Alibaba was at 210, and I said, you know, you should first apply a 30% discount versus a developed market one, because you have very little visibility. And because of this opacity on the Chinese economy, actually, as an investor, first, you are buying shares in somewhere in the Barbados or the Caymans. So that means you don't even own the shares. So that means those stocks could go down. It went down 30, 50% of those names. But I think, Mark, your question is more about the economy. So they get they get the Winter Olympics coming. One of my friends is living there, and they are telling me that they are so freaked out that it's going to be interesting. China is slowing. China is going through a new business model, which is that they announced 5 years ago, that they are push even more this year. Real estate is a big problem. There is a very, very good podcast from those guys at Bloomberg. Ask me, Mark, send me an email explaining real estate and explaining the leverage and how the exposure and obviously the contribution to real estate to the Chinese economy and the Chinese GDP. Story is not that, is still not great. And yes, Jaime, thank you. Hot lots from in Bloomberg. That was exactly that. How much Western money is at risk, you think? You never know with, there were rumors that one of these big hedge funds had a lot of exposure. I'm not going to say the name. China was a good way of financing. Okay, so that means a lot of money went onshore to offshore. So if you think about a way of Chinese people to put their money offshore was to be buying obviously offshore assets. So, and that happened over the last 10 years, even if they try from 2016 to limit the outflows of money. So that's the first thing. In terms of investment from China, I was reading, I don't know where, that the first language in Africa is not China, it's just Chinese, sorry. So we know that they invested massively in everything that is commodities, in ports, in those things. So even 5 years ago, they were buying all the robots companies in Germany. They were buying German cars. So that has implication. Why? Because China is 18 to 20% of the world GDP. So if this let's say 20% of the world GDP, instead of growing by 7-8%, is growing by 2% and maybe not even growing. So if you do 0.2 times 0.007, that makes a big difference. And this is where we stand here on China with, again, very poor disclosure, meaning that do you really want to own the assets? I've never, I use always the analogy of the Chinese assets similar to, and sorry for the Italian that are watching today, of the Italian assets in Europe. So I remember my boss, I didn't learn that much when I was working for this hedge fund, but this hedge fund, my boss told me he got killed into Parmalat. So he was long Parmalat, and Parmalat, that was a big fraud. And he told me one day, he said, Greg, each time you buy an asset in Italy, you put a 20-30% discount versus any asset in Europe. And to me, then I learned that exactly the same when I was working for this hedge fund, which was looking at Eastern European companies where we were applying, 20 to 50% discount. And that's the same with China. You need to be applying 30 to 50% discount. So Fed versus Quadruple Witching Day, very quickly. I've been doing it over and over, so you know the story. Tomorrow and the third Friday of March, June, September, and December, meaning tomorrow, we get the expiries on stock index futures, stock index options, stock options, and single stock futures. Single stock futures, they don't trade anymore, but so they do trade, but no one is using them. So what happens tomorrow is, if you look at any of your charts, you're going to have a crazy volume. Okay, so there's going to be big volumes. There's going to be probably a lot of volatility. But what happens as well, there's going to be a lot of, so 46.60 for the S&P, sorry. So large open interest closing, you're going to have volatility. Again, this is even more true for tomorrow, because this is the biggest expiry of the year, third Friday of December. So very, very big expiry. So be aware of those moves. Put everything into perspective. But again, S&P expiring at the open, SPY at the end of the day. If you look at some European markets, I'm trading them. So the expiry for the Swiss market, for the Italian market, is on the open tomorrow at 8 a.m. UK time. For the UK, from 10:10 to 10:15. In Europe, you get the Stocks 50 from 10:50 to 11. And in Germany, you get a big expiry on the DAX at 12. I think this one could be interesting as well. So look at the last versus what should be expected from the auction. And very often, what happens at the same time with the index, these option expiry, is the index rebalancing. Index rebalancing means, you know, if you take the example of the Stock 600, every 3 months, the committee of the Stock 600 says, you know, we need to be making changes and doing some replacements, some stocks going in, some stocks going out. So that means the adds, the deletes, and some stocks that will have more weight into the index or not. So check those names, Hermes and Richemont. So luxury, one is French, one is Swissy, are going into the Euro Stoxx 50 tomorrow. So watch out the close tomorrow, and Universal Music and Vodafone are out. So this is purely for trading, but sometimes those are good trade, easy trades, especially when there's dual listing. I strongly advise you to do. So quickly now, what I'm going to do next year. So at the start of, so on Saturday, the 8th of January, I'm going to be doing this ID generation for 2022. I've done it over the last couple of years. So this is the presentation here. This is, first, we're going to be going through 2021, looking at what happened, and we're going to be looking at potential trades for 2022. So looking at how to do it with the 4x4 process, looking at the recent performances, how to generate trades with great risk rewards, identifying market drivers and possible arbitrage. So at the start of this year, we look at the euro dollar, for instance. We look at what was that? I think we look at at Mosaic. We look at names like infrastructure. So we've done, I try as much as possible to cover the different assets and give some specific and potential trades with good risk reward. So this webinar is obviously for individuals like new retail traders, but as well for people that are more advanced. Okay, so if you want to join, so I will be putting a link on YouTube at the bottom of the description. Otherwise, you can go on the website. This is already, you can already join. Quickly, holiday season discount, 25% on the 4x4 video series until the end of this month. So you get another couple of weeks. So what I do 3 things mostly. I do the trading community that I'm pushing. So as you can see, this is an idea that I mentioned before. This week we discussed the tax loss strategy, something that I discussed with one of my mentees. I think this is, I try to collect a lot of research, putting some ideas. Second product is the 4x4 video series. So that's 30 hours plus of footage, giving you an investment process, helping you generating ideas with 50 Excel spreadsheets. So building your infrastructure, it works very well. I know some of you have been doing it with some other educators. Trust me, this is a much better product. And finally, the mentoring, a one-on-one session. I enjoy doing it. Places are going to be now limited in Q1. So if you're thinking about Q1, hurry up because it's going to be limited now. And this is it for today. And it was supposed to be a short webinar, and it has been a long webinar. So for this year, this is more or less it for me. Next webinar is going to be next year. I'm going to be starting with the ID generation for 2022. Then I'm going to be back to Market Thursday. I would love maybe to change a bit the format of this format of the Market Thursday. So if you have ideas, please send me an email, share because it has to be, but it could be both ways. If you can help me, you know, doing something that works better for the retail traders and helping you, that will be great, having your feedback. And otherwise, I hope you're gonna have a good holiday, a good Christmas, and Happy New Year. And that 2022, you're going to be making a lot of money. Thank you, all of you, for joining. Thank you for your support. If you like what I do, put some like, do some comments. That helps to carry on. Appreciate. I hope you had a good year, and that next year is going to be even better. Thank you, everyone. Bye-bye.